In this section, I'm going to be talking about price action. As you can see, I have no indicators in this chart. I'll only be dealing with price in time, alright? Every analysis should always start with simple price action. Volume profile and other tools or other indicators can be helpful, especially the volume-based indicators. Those are great. But first you need to see what the price is doing. Only after that you can build on this information and start using some of the indicators. Alright, but first you need to know what the price is doing. Then you build on top of that. So in this price action section, I will show you what to look for in the charts. And first I'll start with telling you how the markets actually work. As I already said in previous videos, markets are controlled and manipulated by big financial institutions, and they control the prices. And there is one thing those big financial institutions have in common. And the thing is that they control massive amounts of money, which they need to place in the market. It's not easy for them to enter a market with such a huge position. So they need to enter their positions in smaller parts. So imagine, for example, a bank like Goldman Sachs or some pension fund who wants to allocate insane amounts of money into market. Let's say that they want to go short on the euro dollar, alright? So those guys need to do it slowly. If they do it fast, then they'll basically start a strong sell-off and they won't be able to enter their positions, in the sell-off. So they want to enter their positions slowly without alerting other participants, without anybody knowing. And they do that in rotation because they can easily hide in rotation. So this is the reason why rotations are that important, and this is the reason why the first thing I look for in the charts is the rotation. Because in most rotations, big institutions are building up their positions. We don't know if those positions are buying or selling, but we know that something is going on in rotation. So that's why rotations are that important, because big institutions accumulate their positions there. And it doesn't really matter if you look, for example, on a 30-minute chart or 1-hour chart. The time frame doesn't really matter because institutions also work on different time frames, so they can, for example, operate on 30-minute time frame as well as on daily or weekly time frame. Alright? So always look for price rotation or for sideways price action in the time frame which you trade. Alright, so that's the rotation. And what happens after big institutions accumulated their positions? After that, they start strong selling or buying activity, like aggressive buying or selling activity, to push the price upwards or downwards from the rotation. This is where they make their money. Alright, they make the money when the price is moving. So first they enter their position, afterwards they initiate a trend. So always there is a rotation in which volumes are accumulated. And from this rotation, the price goes into a trend, uptrend or a downtrend. And this is how markets work. Most of the time, it's just rotation followed by a trend. And that's it. Accumulation followed by a trend. Then again, accumulation and a new trend. What usually happens is that the volume accumulation takes more time than the trend. This is quite common. If you want a strict definition of how rotation looks like or how sideways price action looks like, then I have sort of a rough definition for you. When there is a rotation, then the price candles always almost overlap. So for example, if you look into this rotation, you can see that the candles overlap each other. There are no sort of gaps. But afterwards, there is a trend and the candles don't overlap each other. For example, in this place, they don't overlap. Right here, they don't overlap. Or for example in here, the candles don't overlap, or mostly they don't overlap. This isn't a hard rule for you, but it is something how you can roughly tell if it's a trend or no. When you spend some time watching the chart, then it will be easier for you to make the distinction. This is another trend area. This is another trend where the prices don't overlap, alright? But for example in here, the candles overlap, or in here, they overlap. Or you can look in this whole area, more or less the candles overlap each other, so this is a rotation. So if the candles overlap each other like this, then it is a rotation. If they don't overlap, then it is a trend. So before you, this is the Eurodollar daily chart starting in 2014, and I would like to show you how I analyze the markets and how I see the charts as far as the rotation and the trend is concerned. So let me show you in this chart how the rotations are almost every time followed by an aggressive trend. So let's start in here. Right there, this is a rotation. Most likely sellers were accumulating their selling positions there. Afterwards, they started this downtrend. This is a trend. Alright? You can see that it's a really aggressive downtrend, really strong one. What happens next? Another rotation. Then, from this place, after the rotation is over, again, there's a trend development. After that, it's sort of harder to read, because there were rejections of lower prices, which indicates aggressivity of buyers rejecting the lower prices. And when something like that happens, this means that the trend could be over. If you see rejections of lower prices which go against the downtrend. Alright, so this was the first sign of the aggressive downtrend ending. If we go further, then you can see that it's a bit harder to read in this place. Right there, it's sort of up and down situation. The price is getting basically nowhere. Then there was a rejection of higher prices, really aggressive one, and afterwards there was a rotation, another rotation in here, and some strong selling activity. So again, you can see a rotation followed by trend, right? Then a rotation in here followed by a strong trend development, strong buying activity. Then there was a rotation, the buyers were adding to their buying positions, and afterwards again they pushed the price higher into an uptrend. The uptrend is not as strong as, for example, this downtrend, because this was just crazy, alright? But still, it is an uptrend, is aggressive buying activity which occurred after this volume rotation. So what happens next is rejection of higher prices. Sellers rejected higher prices, and funny thing, they reacted to this rotation. So those sellers were defending their selling positions and they pushed the price downwards from this area. Another interesting thing is that as soon as the price hit this area where the buyers were accumulating their buying positions before they pushed the price upwards, then those buyers started to buy again and they defending their buying positions. And from this place they pushed the price upwards again. Then there was another rejection of higher prices, and then a little rotation, followed by a trend. Then a little rotation